All right, welcome back to Roadmap to Retirement. I'm your host, Alex Neary. Today we have Jamie Abraham.
Welcome to Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neary, CFP, and guests are here to help you build your roadmap to retirement.
Jamie, who are you? What do you do?
I'm Jamie Abraham. I am a CPA at Gray Locey CPA, and I am a tax manager there. So I deal with a lot of individuals. I deal with a lot of businesses and help them with their taxes and planning in that sense.
Okay, perfect. So CPAs are notoriously boring. You're okay with that, right?
Yeah, we're boring.
All right, but this is going to be an exciting episode, so I can't wait. So let's kick us off. So we get the question a lot from our clients that want help with their taxes, and we find that obviously with the rise of things like TurboTax and different software programs, that there's a lot of people that are choosing not to work with a CPA. Sometimes it's cost saving, sometimes they just want to do it themselves. But in your mind, from your experience, when does it make sense to work with a CPA rather than doing it yourself?
So basically, if you're just say a W-2 employee, it doesn't always make sense to work with a CPA because generally what you have, you can use TurboTax for. So you get a W-2 at the end of the year, and then you just file your taxes based on that. If you have more going on, say you have a business, then I'd say it's time to talk to a CPA versus trying to do that on your own. Even if you are a W-2 employee, so I would recommend talking to a CPA. It's always a good thing to talk to a CPA. Even if your taxes aren't complicated, they can help you in many different ways. They can help you plan for taxes, or say you're getting a W-2, but your withholding's off. We could help you fix that.
Yeah, I think that's the big thing that we see is when people are going through some kind of transition, whether it's a new job or they've just retired, and then all of a sudden they're like, my taxes are different, what do I do? And they don't feel as confident as they did before if they were filing themselves. I think you mentioned withholdings, and that's a big one if you've just retired, and now you've got to figure out, should I be withholding on Social Security or my pension, or I'm taking distributions out of my IRA, do I withhold 10%, 20%, what do I do? I think that's a good time to talk to a CPA is when something changes there.
Yeah.
Or you just have an unusual year. If you inherited money or you had to take a bigger distribution than normal, I think there's opportunity for that one-off question. Is that something that most CPAs are willing to handle? Is just the, hey, I've got a quick question call, but maybe I don't need you to file my taxes? Or how do you balance having that professional relationship?
So like me, I will take the call, but you get to the bigger firms and they're generally gonna not even bother with it.
Sure. It makes sense. It's a business. You got to get paid, or the firm's got to get paid. But I guess I would recommend to some people, if you are going through that change, even if you don't think that you need a CPA every year, maybe that 1 year where things are a little bit different, consult with a CPA. Maybe you learn what you need to do in the years going forward. And if you have an awesome time working with a CPA, maybe you want to continue that anyway. What are some of the big misconceptions that exist? I think that we get this question a lot. People ask us if we do taxes, and I've got to explain to them that no, we don't file your taxes, but we do have a hand in tax planning. And of course, you take tax planning from the other perspective. But what are some things that people maybe have misconceptions about for what a CPA should be doing for them?
So what a CPA should be doing for them, a lot of people think that we will handle your investments. People think that we know what's going on all the time without you telling us. So a lot of times at the end of the year, we'll see someone has large capital gains. And then they'll come yelling at us, why do I owe tax on these capital gains? When they never communicated to us that they had capital gains through the year, so they're going to owe a little more tax.
Yes. So that's a perfect kind of area where we overlap, is we're working with our clients at the end of the year for tax loss harvesting, try to take care of those capital gains. And the CPA is then going back months later and saying, hey, you had these capital gains, what are we going to do about it? And a lot of times it's too late. So I know for ourselves, having good professional relationships with our clients' CPAs so that we can have that give and take is critically important. Another area that we see a lot is when it comes to making contributions to IRAs. Mm-hmm. We hope that if they're working with a CPA, when the CPA is going through the taxes, they're going to say, hey, you have an opportunity to contribute an extra $7,000 to your IRA, and it's going to change the amount of income tax that you either owe or what you're getting back. And then you should be, again, working with the advisor to make that contribution happen. What is your experience with things like that? Or what else am I missing from that?
I like working with the financial advisor. It definitely makes my life easier, your life easier, and the client's life easier. Because if we communicate together, we can actually plan out what's going on. So say you're going to recognize a $50,000 gain. We can plan for that. Mm-hmm. Versus no communication at all. End of the year, they have $50,000 gain and they're paying tax on it.
Yeah, I think planning is a key word. We run into people all the time where they get to April 15th, and I know you deal with this.
Oh, yes.
They're filing their taxes in April, and they say, oh, no, I had this gain, and what can I do about it? Or, oh, I should have done a Roth conversion. What do I do about it? And for those of you who don't know, there's just different deadlines. So for any kind of recognized sale you're going to have of a stock or asset, you need to do that by December 31st. If you're going to do a Roth conversion, again, December 31st. So when you get into the spring and you're filing your taxes and you want to make a change, it's too late to do that. So the appropriate planning ahead of time by working with the right professionals can save you a lot of money in taxes. And I'm sure you have some horror stories. Maybe we won't go there. Do you have a quick horror story?
Quick one.
Of course, leaving out the names and details, but like a general concept.
Yeah. So I had a client. She was out in California, didn't communicate with us at all during the year. End of the year, I look at her brokerage statement. Shows that we have about $300,000 capital gains. She thought this was all in her IRA. So she thought it was all tax-free. This is why you need that communication between the two parties. And then she owed about $100,000 in taxes that she had no idea was coming.
Yeah, it's a nasty tax bill.
It is.
Yeah, this is one of the things when we talk about in financial planning. I've done this in several podcast episodes or had this topic come up. And it's, as a financial advisor, we find that a lot of people want to just focus on the rate of return of their portfolio. And that's a great example of how you're not seeing the forest of the trees, or the tree. How's that saying go? Not seeing the forest of the trees, the forest, whatever the saying is. But the point is, you get so focused on the investment return that you lose the opportunity to not do the proper tax planning. And all of a sudden you've got a $100,000 tax bill because you just didn't understand what was happening. So I think that's a huge opportunity. And this is not to stand on my soapbox too long, but this is why we try to have these review meetings with our clients where they are meeting with us every spring and every fall. The fall one is about those things that need to be done by December 31st. So tax loss harvesting, Roth conversions, and making sure that's done by the end of the year. And we like to do it in the fall so that we're not running around the week between Christmas and New Year's getting it done. And then the same thing in the spring. We want to have another conversation when you're filing your taxes and making sure that you're not running into these things so we can plan ahead for next year. Yeah. So that's a fun horror story. $100,000.
Yeah, I think it was a little more than that, but yeah.
Was she upset about it?
Oh, yeah, I got yelled at on the phone. Awesome. Then she called a while later, thanking me. Like, sorry, I yelled at you. Not your fault, my fault.
Those are tough phone calls. At least she realized it.
It's not an enjoyable phone call telling someone that they owed that much money.
Yeah.
Especially when they weren't expecting it. They don't normally have that amount of money. Right. That's like the worst one is when they don't even have the money anymore because they didn't plan ahead.
It's $100,000. I don't know a lot of people that could get a bill for $100,000 and not think too much about it.
Yes.
That's a pretty good spot to be. So we are going to change gears in a minute here and talk about some just tax planning tips for small business owners. Before we do that, though, what do you think is something that maybe the normal not business owner client of yours needs to understand about their taxes? Maybe a common misconception or something that they don't understand when they go to file their taxes?
Something they don't really understand.
Or maybe just a common mistake that people make on their taxes or something you think they could do differently.
A lot of people, again, with their brokerage accounts, they don't know what's going on at all with that. So they could tell you what they're going to make on their W-2, and then you could plan for that, but then they don't tell you about these unforeseen gains that they have happening. Yeah, and that's definitely a big problem I've come across.
I would say just understanding that like different accounts are taxed differently and how that plays into everything else.
Yeah.
One that we see all the time has to do with Medicare and the way that Medicare is taxed effectively, or your premium is determined. You have the table for that, and people go over the threshold, and all of a sudden they're in a higher bracket. Yeah. The IRMA table, income related monthly adjusted amount. So those capital gains tax, distributions from IRAs, and all of a sudden they're wondering why they're going from paying the normal $174 for Medicare to an extra $100 or $200 a month. So those are fun examples.
Yeah, and then I guess a lot of people don't understand that Social Security is taxable. Yes. It's not 100% taxable, but it's, depending on your income, it goes up to 80% of it would be taxable.
Yeah, that's a fun little game they played. So originally Social Security was not taxed, and then our politicians decided they needed more revenue, so then 50% could be taxed, and then a couple of years go by and we need more revenue again, so now 80% can be taxed, and I think people don't understand that.
No.
Depending on your other, like you said, we don't get into all that right now because that's too complicated. All right, turning the page. So we talked about tax advice for normal W-2 employees. And I had this whole other kind of wild west of small business owners and the things that they need to know to run their business. And I think this is a unique area from both of our perspectives because most people that are running a business, they don't get into it as a business person first. They have some kind of passion. They like making things, doing something, and they want to follow that and make it a career. So all of a sudden they're backing into the business end of it, and they're learning about accounting practices. They're learning about how to fund a business and how to scale and all that stuff. So what are some things that you think that small business owners, will say people that have whatever, less than 20 employees, need to understand about their tax situation?
For one, they need to understand what type of business they are. So you could be an LLC filing as a partnership, you could be an S corporation, and you can be a corporation.
Mm-hmm.
Or you could be on your own individual return as a single member LLC. And the way that would work is you'd be reporting that on a Schedule C on your return. What a lot of people don't understand is that, say like you're a Schedule C business, they don't understand that you can't intermingle all the funds. So like a lot of times I'll see clients where they intermingle their personal house because they use it as their office.
Mm-hmm.
So I see that happen a lot. And then it's just hard to figure out what's going on when they do it that way.
Sure. Yeah, I think just even keeping accounting records. Do you recommend people use some kind of whatever, just QuickBooks, or I'm sure you get like the spreadsheet from hell every tax season where they just say, oh, here's all my stuff, and it's not really organized, or you get just like a shoebox of paper statements.
Yep.
So what's step one if someone's listening to this and they're trying to get their business more organized? Where do they start?
So you could start in Excel, or you could start in QuickBooks. I personally like QuickBooks. It helps you keep track of everything. You automatically can download bank transactions, and it just helps make sure everything is there. And really doing it in Excel is much harder to do because you have to go through every month and make sure you have everything.
Mm-hmm.
And from my perspective, it's hard to actually see what's going on versus say you're in QuickBooks or some other accounting software that keeps track of everything and makes sure that everything's in there is actually showing up somewhere. That way you don't have these ghost transactions that are going accounts payable to accounts receivable where they just vanish into thin air.
Yeah, I think for most small business owners, the name of the game for taxes is keep the IRS out of your stuff. Don't give them something to start sniffing around, because obviously an audit is a headache no matter what, but if you have everything buttoned up, it's a little bit easier.
Yeah, and don't record every single meal that you go out for. Make sure it's actually for business, because you may think that you're getting a full write-off for that, but it's only 50% that you'd get for that meal.
Right.
And it has to be business related. And then you don't want the IRS coming sniffing and then going after those kind of deductions.
Right.
Because they can go check on those and see, all right, was this actually business or was it not?
Yeah.
You want to have backup for everything that you do in a business.
So how does the burden of proof work for that? So if I go out for a meal with somebody and I write it off and then the IRS audit's made, I've got to prove that meal is business related. I've got to prove that person's a client. Where's the line there?
So really so say you have employees going out for meals.
Mm-hmm.
This is like the easiest example of it. You would want them to indicate what they were doing, what the meal is for, and then just keeping track that way. And that's the simplest way.
Okay.
Or say like you have business mileage deduction. You actually want to keep a data log of every trip that you make. As painful as it is, if the IRS ever comes back, you'll still get that deduction.
Sure.
If you just generalize and say, oh, I had 1,000 miles for the year, they're going to come back and then you have no proof to show that you actually had those miles.
Yeah, that could be a slippery slope.
Yeah, and New York State really likes to come back on those.
Say anything bad about New York State on the recording, but okay, so you brought up a couple interesting things, and a lot of them have to do with these write-offs. So every small business owner is probably trying to maximize the write-offs that they have. What are some things that either people forget that they can write off, or things that they're writing off and maybe they really shouldn't be pushing it?
So back to the business miles. A lot of times people try to write off their vehicles that are their personal vehicles.
Mm-hmm.
You have to show that you have business use of that vehicle, at least 50%, to really get the proper deduction for that. And I have a lot of people that will try to just say, oh, I bought a new vehicle this year, and they bought like a $100,000 Mercedes. And they can't just write that off. You have to prove that it's for your business and that it's only for business use.
Yeah, I'm sure some people know some wild things like, oh, this RV or this yacht is for business, or
yeah, like you have people. I've had one person try to write off a boat.
Well, I mean, if you're doing meetings on the boat, I think you can.
Yes, like you can't write off a boat unless it's a boat business, pretty much.
All right.
And even in that case, there's a lot of scrutiny behind that.
Mm-hmm.
You got to limit your personal use of that asset, and you have to make sure that's really for business.
Sure. I know we have a lot of small business owners that you tend to start out small. You might be running a business out of your house or your garage, whatever it is, and you have the home office deduction.
Yeah.
But there's some rules around how that works too, right? Like, what are the limitations to that?
Yeah, so for the business use of home deduction, it is essentially a portion of your house that you have a dedicated office space. So say you have 1,000 square foot house, you have 100 square foot office, you'd be able to take a deduction on expenses for your whole house, but as a portion of that 100 square feet.
Mm-hmm.
So essentially you would have 10% of that would be for business. So you'd be able to take your mortgage interest that you pay, your real estate taxes, your mortgage insurance or your property insurance, then your utilities, and then really general repairs and maintenance.
Okay. So that's a big deal. That can
Yeah.
add up pretty good. So that's something that if you're not taking advantage of that and you have the ability to, you definitely want to make sure that's
Yeah.
reflected. And that might be one of those things that like falls in the umbrella of why do I need a CPA? You probably get a lot of people that are trying to do it themselves. I think they know enough to do it, but
Yeah.
they probably know enough to be dangerous. And working with the right CPA, they'll probably find things like that
Yeah,
more than cover the fee that you're charging them to save on their taxes.
Yeah, and then another thing with the business use of home deduction is there's a simplified method where you can take up to 300 square feet of your house and say it's for business use,
Okay.
and then you'd get $5 a square foot. for
Okay.
that. So it goes
So-
up to 1,500.
It's a good way to do it. Especially if your house is only 400 square feet, then
Yeah,
it's a pretty big
I think
swing.
your whole house is there. Yeah.
Hopefully not. Cool. So we talked a little bit about that, or about the deductions part of it. Another thing that we run into a lot, and this kind of, again, is that overlap gray area between the CPA and the CFP, different types of retirement plans that either business owners can be taking advantage of themselves or things they can provide to their employees. And we've done a whole episode on 401k plans, so we'll brush over that. But let's just start with the sole proprietor. You're in business for yourself. You don't have any employees. What are the best options in your mind?
Yeah, so really, I'd say if you're just starting out, you don't have any employees, you don't necessarily know what you're going to make at the end of the year, I would recommend always doing at least an IRA.
Mhm.
But that is also limited to your income, which is the drawback of doing an IRA. Then you could do an individual or a solo 401k. And then you can even contribute to a Roth IRA. Then there's a simple plan.
Mhm.
There's defined benefit plans, which are like a cash balance plan.
There's SEP IRA. Everyone loves a SEP IRA.
SEP IRA, yes. Yep. That is one of the more common ones, is a
Yeah.
SEP IRA.
I find from my experience, a SEP IRA is probably one of the easier things to do. You have a high
Yeah.
limit of what you can put into it. You don't have the administrative costs you have with a 401k.
Yep.
So for a very small business, I think it makes sense. The issue with that is when you get into having employees, now you can't discriminate. And I don't want to get too into the weeds on this, but if you're making a contribution for yourself as a business owner, you need to be doing the same thing for your employees. So it can get expensive from that standpoint.
And then it gets a little convoluted from there versus you contribute for yourself or them.
Right. But the point of this is from a tax standpoint, you're giving yourself an opportunity to put in money pre-tax, which can help you out quite a bit, especially if you're in a growing business and you find that it's a good problem to have, but you have more income all of a sudden than you had planned on having the rest of the year. And
Yeah.
you're either going to pay a high tax rate on that or tuck it away and save for the future. Generally speaking, one of the financial planning things that I see small business owners struggle with is saving for retirement, because compared to somebody that starts at a normal company as a W-2 and they plug into having a 401k right away with a match and all that good stuff, the small business owner doesn't have that. So it's on them to go out and actually set that thing up and start saving money into it, and to make the decision that it's time to start saving, not just putting all the money back into the business, which is a trap people fall into. But do you have any experience with that?
Yeah, I do see it a lot where people will just be putting all their money into the business. They'll make money in the business, but they won't put that into themselves and put it into a retirement plan.
It happens all the time. I think a lot of small business owners also fall into the trap of they think about how the business they're building has value, and it definitely does. And they think someday I'm going to sell this business for $10 million, and that sounds great, and maybe that'll work out for them. But there's a lot of things that can change in your business and the economy, and maybe you get to the point where you're 65 years old and you want to sell your business, and like the world's just changed and there's not value there. So making sure that you save money for retirement, even if you are going to have the sale of that business, I think is critically important.
It's definitely important to save for retirement, no matter if you're a W-2 employee or you own your own business.
Absolutely.
But that is one of the most common things I see is people that have these businesses not contributing anything.
So let's talk about the other end of that. So we mentioned when they sell the business. So that's another thing where they're probably going to need a CPA. So let's say someone's listening to this, they've owned a business for 40 years, they're finally getting ready to sell it. What do they need to know about the taxes as that happens and all the things to do with the sale?
Yeah, so generally when you sell a business, any of that profit that's over what you have into the business is going to be treated as a long-term capital gain. And really what your basis is in that business is all the profits that you have every year. And that just accumulates in the business in this thing called retained earnings, which is essentially when you go to sell it, that's going to be your basis in that business. And then whatever you sell it for, less that basis, is going to be your long-term capital gains.
Okay, cool. So what if I have a business and I decide I don't want to sell it, but my son or daughter wants to take over the business? How does that happen from a tax standpoint? If I want to just transfer it into their name, is that a gift? Is that a taxable event?
It all depends on your treatment of that. So that's generally what you would deal with a lawyer and an accountant for.
Okay.
It's really
We had a lot of people involved all of a sudden.
Yeah, because the transition of the business can go many different ways. You can gift the business to someone. You could transfer shares. The son or daughter could buy shares. They can do a lot of different things to get involvement in that business.
Okay.
They can slowly buy in, stuff like that.
So I think that's something where it's probably intimidating for the person selling the business. There's so many moving parts. You're talking about a CPA involved. You think there should be an attorney involved. What is like the first step if I say, hey, I'm ready to sell my business? Who do I talk to? Where do I want to go?
So I would say talk to your accountant, and then we can talk about transitioning and what you want to do with that. If you want it to go to your son or daughter, if you want to just sell it, whatever you want to do, we can get a start there, and then we can set you up with lawyers and just family business planners, because there are people who do that where they help a business go from generation to generation. So really, the first step, I would say, contact your accountant. Say, I'm looking to sell my business, or I'm looking to transfer it over to my kids. How do I do it?
Okay. That's so much of what we're talking about today is like, how do you start? Like, people are probably listening to this thinking, this is stupid, complicated. I don't want to deal with it. You've got everything from which type of corporation should I have, to how do I sell my business, to what should I be thinking about when I file my return. It's not so much that any small business owner needs to be an expert on these things, but they just need to know where to start. Do they go to Jamie and he tells them how to do it? Do they go to somebody else? Figuring out what step one is and then trusting that professional to guide them through the process. I don't want anyone listening to this to think they need to become an expert on all the things that we're talking about. No. It's just figuring out where to go. Okay, do you want to have some fun now?
Sure.
All right, Jamie, I don't know if you know this or not, but there's an election coming up. Did you hear about that?
No, I don't think I did.
So with that, there's always tax changes, right? There's people proposing different things. We have the current tax code that came in, 7 years ago now or something? Is that right? Yeah. 7-ish? Okay. Putting you on the spot here. So there's possibilities that won't continue. There's possibilities that there'll be a new tax code proposed and maybe implemented. So where do you see the federal tax brackets going in the future if you had a crystal ball?
If I had a crystal ball, it depends on the way the election goes.
Okay.
But generally, what we expect as accountants is taxes to increase year over year.
Okay.
So the brackets, the income in those brackets may increase, but we do expect the percentages to increase as well in the future.
Okay. So we are still in a historically low tax environment. Yeah. That's what the headlines tell us, right? There's more to it than that. Do you feel that, I don't want to make this too political, but either party wins? Do you think that we're probably due for taxes to increase just based on the spending in our country and other things?
Yeah, I can see taxes increasing and them changing the way things are taxed as well.
Okay.
You can see some benefits disappearing. So like for small business owners, there's this thing called bonus depreciation. So what happened in 2023 is they reduced the amount that you're allowed to take. So you used to be able to have a new fixed asset. You could take 100% deduction for that. Now in 23, it went down to 80%.
Yep.
And then next year, it's going to be 60%.
Okay. So does that have to do with if you buy a vehicle for business purposes, depreciating that, or is this different?
It can be a vehicle. Generally, their depreciation is a little wacky and different. Okay. But say you're just buying a piece of equipment for your business, you could take 100% bonus depreciation on that in the past. Now you're limited to taking only 80% of that. So if it's $100,000 equipment, you would only be allowed to take a deduction for $80,000 in the first year.
Okay.
And then next year it'd be $60,000 if you place it in service that year.
Got it. Okay. It's interesting. It's one of those things where I think that people have different opinions on the political whatever, and we're not, again, getting into politics, but regardless of how you feel about things, like the tax code will continue to change and evolve. So
Yep.
I think for us as professionals, it's a challenge of making sure that we're staying educated on what's going on and what might happen in the future. And then for people that aren't in our types of businesses, it's making sure that you understand it enough to make better decisions for yourself moving forward. So stay tuned about tax changes. It'll be exciting.
Yeah.
Cool.
Definitely see them going up in the future, though.
Yeah, I think.
But you never know. You don't have a crystal ball.
Right.
But the best way to do it is plan for the now and the future. So essentially, say you want to take a distribution out of your IRA. Just know that money's worth more now than it would be tomorrow.
Sure. Yeah, that's a huge part of the conversation with things like Roth conversions too, which I always talk about Roth conversions. We have clients who are retired right now and they have the opportunity to convert and do it at 12%.
Yeah.
Which I don't know where tax brackets are going in the future, but I'm going to guess that 12% is going to look pretty good if you look back in 10 years.
Yeah.
So like maybe doing that, maybe that's a good move. It's hard to say for sure.
Yeah.
So I got through my kind of prepared list of questions. What else do you want to talk about?
Misconceptions that you see as a CPA.
Okay.
So a lot of times people think, oh, I have a capital gain or a capital loss this year, and I can take a deduction for that. So say you have a $30,000 loss on a stock sale. What they don't know is that you can only take up to $3,000 of that, which is one thing I see a lot and a lot of people complaining about, but I lost $30,000. Why am I not getting that? It's because you don't have the capital gains to offset that, and you don't actually lose that deduction. You get it carried over a year.
Yep. Take those $3,000 for a while.
Yeah.
Yeah, I think that goes back to the proper tax planning about the tax loss harvesting and making sure that you're offsetting your gains and your losses appropriately. And I think another thing I don't want to go too off topic here, but we have a lot of older clients that are starting to sell stocks for whatever reason. And the reality is if this isn't money you're going to spend in your lifetime, and your kids are going to spend it when you pass away, they get a step up in basis, which means the basis becomes the fair market value at the date of death. So a lot of times we see people making mistakes with selling positions that have a large appreciation in it because
they want to gift it. Yeah.
Because whatever, because they want to gift it, because they think that that company is not going to do well in the future, because they have whatever reason that justified it. But I think a lot of times looking at it with a professional and making the objective decision to not sell certain positions that you probably don't need the money from can make a lot of sense. But that's off topic.
You don't always have to look through the lens of taxes when you're doing that stuff too. Make sure you cover yourself personally. Like you can cover all your personal finances too. You don't want to just look at, okay, I need to do this, so let's do X, Y, and Z, and then I have no money at the end of the day.
Yeah, I think people make knee-jerk reactions a little bit.
Yeah, you can't just do it that way either. You want to make sure you still have what you need to live comfortably.
Yes, that's you're preaching to the choir there.
Yeah.
Cool. Any questions for me?
What do you find most difficult when planning with a client?
What do I find most difficult when planning with a client? I think a lot of times it's at the initial onset of a client relationship, it can be tough to get people to buy in terms of getting all the relevant information. Like once in a while, people bring 80% of the information we need to put together a financial plan. And the other 20% requires some digging on their work, or like they've got to actually get in the weeds. They've got to get on the phone to chase down that old employer stock plan and they haven't had a statement from, or they've got to look into just some details about their expenses and that kind of stuff. So it's hard to do proper financial planning when you're only seeing part of the information.
Yeah.
Or we get a situation where you've got a married couple and maybe the wife is really motivated to get the financial plan in order and she wants to do this, and the husband's not really buying in. So you end up having a lot of conversations with the wife, but not the husband, and you don't have both parties on board.
Yeah.
And when you got married, you agreed to do this financial thing together.
Yeah.
And there might be information they don't know. Or we're really going off topic here, but I've had conversations with one spouse where they're like, oh, I have this account that they don't know about. Don't tell them. And it becomes uncomfortable. And I've got to say, if we're going to have a professional relationship and work together, I need you to agree to have this conversation with both parties. I can't be in the middle of keeping secrets between married couples. But we got to wrap it up. Any last thoughts?
No.
All right, awesome. We did it. Jamie, thank you for being here. This has been the Roadmap to Retirement podcast. Thank you all for listening.
Yeah, thank you for having me.
You got it.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice. Nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory are registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.